Investors are virtually certain that the Federal Reserve will launch another round of quantitative easing on Wednesday, according to the latest survey by CNBC. 99% of respondents expect a QE announcement from the FOMC meeting, up from 93% in October and 70% in September. Respondents were also asked to predict how much the Fed would ease by, with market participants on average looking for a figure of $457 billion in asset purchases. Well, currently the Fed itself is deeply divided. 7 members are hawkish, 6 are dovish, and 4 are neutral. Of the hawks, Dallas's Richard Fisher says he cannot see how effective QE2 could be. But Charles Evans, who has called for much more easing, says the time is right for more policy accommodation. New York's William Dudley said he is also committed to bringing rates down. But St. Louis' James Bullard says he does not support another large-scale plan.
We're joined now by Robert Skidelsky, Lord Robert Skidelsky, Emeritus Professor of Political Economy at the University of Warwick and biographer of John Maynard Keynes, of course. Thank you very much for coming in. So let's get your take on what's happening in the United States at the moment. Do you think that QE2 has merits at this time?
Well, it's the last throw, because fiscal policy is going to be blocked. So they can't do a fiscal stimulus. The economy is growing very, very slowly. And so they then have this one weapon left, which is to flood the banks with dollars. But, you know, it didn't work very well last time. And there's many a slip twixt cup and lip. And you can print a lot of money, but the important thing is to get the money spent. And if people aren't in a spending mood, then it just accumulates in reserves or, you know, in speculative activity.
Markets seem addicted to these kind of shots in the arm that central banks have been providing. And whilst it's completely understandable when we were on the brink of financial collapse that we would see some enormous heavy-handed, heavy lifting from central banks, including the Fed, now the bar seems to have been lowered considerably in terms of how disastrous things need to be before we see these extraordinary measures taking place. Do you think that's a mistake?
Well, I don't think it is a mistake to be worried, because I think the world economy, I mean East Asia and some countries apart, is very, very flat. Recovery has been going on, but it's a lot slower than people expected, and that's obviously true in Europe, where everyone, and it's also true. I think it's going to be true in the UK.
Slower than expected, is that a reason to spend $500 billion?
I mean, if unemployment is going to go up, if the output gap isn't going to be closed, I mean, you know, you've got millions and millions of people unemployed, and in fact, the unemployment rates may be rising. So it's certainly worth trying to do something. And, you know, spending that, trillions and trillions of dollars, it's really it's not printing money. I mean, that's a bit of a mistake. It's actually increasing the liquidity of the banking system and of the corporate sector. But it's the spending of the dollars that makes it money.
If you actually have any more liquidity, I think everybody's going to drown. I think that's the biggest problem here. But I think, coming back to a point, you're an economic historian, and I think the most interesting question that I have for you is, does that really mean that Thomas Carlyle was right, that it's a dismal science, or what P.J. O'Rourke said, that economics is a science of not saying anything, that basically the fundamental explanations we have and the tools we have are very limited, and we can't really do very much about what is actually happening as a natural process? What do you think?
Well, economics isn't a science in the sense that physics is a science. You can't predict, what's going to happen. People don't know. The future's uncertain. But you do have theories about it, and whether you've got a good theory or bad theory is very, very important. Now, I'm a Keynesian. I think that when the economy has slumped because of great financial crisis and its effects on the real economy, it hasn't got any natural forces of recovery that are strong enough to bring you back to where you were in any reasonable period of time.
Isn't this what the Keynesians always say? They always give up on the private sector, and historically they've been proved wrong. Look at the early 1990s, where we saw similar concerns about public sector job losses, where we lost tens of thousands of job losses. I think it's 75,000 or something it was in 1994. But at the same time, the private sector created vast tranches of jobs which dwarfed the public sector losses in the 1990s. Already in the past 12 months, despite how difficult it's been in the United Kingdom, we've seen the creation of 300,000 private sector jobs. Why are you giving up on the private sector, which is actually doing rather well, considering?
Well, of course the private sector will do well under many circumstances, but you have to be clear about what those circumstances were. In the early 1990s, first of all, the output fall wasn't nearly as great as it is now, and secondly, the rest of the world was actually, doing rather well. So that if you have a source of demand in the world, then of course the private sector can offset, and easily offset.
Emerging markets prop in the early 1990s. Yeah. We didn't have China in the 1990s. We didn't have the Indians, the Australians, the Scandinavians raising rates in the early 1990s.
Yeah, but we had a lot of growth in the rest of the economy, which we exported to. We're not going to do brilliant. The export trade isn't going to do brilliantly by exporting to China. The Chinese still run a huge current account surplus. They're great importers, but, they don't like exports that much. Our main export markets are Europe and the United States, and they're both flat.
Can I just say one thing which I always finds interesting? Ben Still said it, I don't remember the exact quote. He said, when the facts are on your side, you pound the facts. When the theory's on your side, you pound the theory. And when nothing's on your side, everybody pounds Keynes. It basically seems to be the way the world works.
No, Keynes, well, of course, this was true in 2 or 3 years ago. The existing economics just didn't foresee the crisis. In fact, the existing economics, the mainstream, said that this kind of crisis was impossible because financial markets are efficient and they wouldn't land you in this kind of mess. Now, when you were landed in this kind of mess, and remember, the slide was precipitous.
It was.
So governments had to do something. Politically, they had to respond. And Keynes, it wasn't Keynes in theory. Even before, it was just governments had to do something. And otherwise, you would have got another Great Depression. I'm convinced of that, and I think many economists agree with me.
Looking at the UK and where we find ourselves at the moment, there seems to be a lot of criticism of George Osborne on many fronts, and you have been a vocal critic of what he's doing at the moment. But one of the areas where he's criticised is for being ideological about this cutting rather than looking at history. Is being ideological about the way that you manage the economy, is that always a bad thing?
Yes, it is, I think, because I think it means that you tend to ignore facts, and you don't have a proper theory. I've never been able to understand why George Osborne believes that cutting the public sector deficit when you have large unemployed resources is somehow going to increase, grow the economy. It just seems to me counterintuitive. If everyone is cutting spending, including the government, where is the source of growth?
But isn't being a Keynesian rather ideological as well? Because you have a way you see the world, and that applies in many different circumstances.
No, I don't think so, because I think there's quite a robust theory. After all, he wrote the General Theory of Employment, Interests and Money. It was a robust theory. Milton Friedman had a theory. It was monetarism. I don't think it's that brilliant, but it was a theory. And if people were prepared to say, this is my theory, this is why I think this will happen, then I think you pay close attention to them.
What's the tool, sir? Because, and I want to get this into a conversation about QE, and I know we haven't got a huge amount of time, but QE, is that the right way forward? Because, I think you're implying, and a lot of other people imply as well, Das, that actually QE tends to be about refinancing the financial institutions, which aren't playing ball. They're just punting the money on the market. They're not sending it on to the people who need it. So QE stroke Keynesianism isn't working in its current form.
Well, remember to distinguish between QE and Keynesianism. QE is straight monetarism. It believes that if you print more money, it'll be spent by someone, and that's how the economy will go. Well, what happened? The Bank of England in 2009 injected 200 billion into the economy. Bank reserves quadrupled, lending didn't increase. And so it's exactly as you say, it just piled up or went into the stock market.
But I think the fundamental thing is the theories, as you correctly say, and they might work in theory, they're not working in practice. I prefer Warren Buffett's view. He once described his investment practices as working in practice, but probably wouldn't work in theory. I'd prefer that in this particular environment, just to get the economy going.
Gents, thank you very much for that. Lord Skidelsky, thank you very much for coming in today. Emeritus Professor of Political Economy at the University of Warwick, and Satyajit Das will stay with us, of course, for the rest of the programme.